Good morning, John. Well, we've finished our second week in a row of absolute ridiculous roller coaster activity in the markets, and it's got me feeling a bit curious. I've been searching all the news outlets and the media, and everything that I'm reading about is different headlines on why the market fell like it did. Was it China devaluing their currency? Is it oil plummeting under 40 bucks a barrel? Is it the threat of the Fed raising interest rates? All these whys are being discussed as to why the markets have fallen and gotten so choppy. Now, my first bit of curiosity is that I'm not seeing anybody in the media talking about why the markets had the explosive growth they've had for the last several years that have led us to this point where we've seen this correction and this pullback. The prognosticators and all the people in the media seem to be so fixated on only answering the why it's falling, and they never really seem to talk about why the growth has gotten so out of hand. The second bit of curiosity that I have has to do with, what does the why even really matter at the end of the day? I mean, the media outlets are trying to provide us with a why this is all happening, like that's supposed to help us take action and do something about it. I think what's more important, especially for our viewers here on Saturday Summary, is to realize that whatever's happening out there today, the why really doesn't matter. The fact of the matter is that you have to have an investment strategy in place that can react on a dime, to be offensive in bull markets, to be defensive in bear markets, regardless of what all the whys are. So I encourage our Saturday Summary viewers to spend less time trying to answer why the markets are doing what they're doing, and spend more time really thinking about a thoughtful way that they can communicate with their clients on how to position their risk assets in something that can be protected and can be reallocated on a dime, regardless of what's going on in the news and the media. Now, one other quick point, I do have to go back to what I said earlier about why markets were moving up and the lack of explanation. Now, this is important to understand, I think, a little bit, because it'll put in perspective why we have the urgency to talk about protected growth today. All this growth in the marketplace that we've seen the last several years, John, I wish it were based on good old-fashioned supply and demand, where investors like you and me and our Saturday Summary viewers were piling money into the markets. Well, that's just not the case. What's been happening, contrary to what we've seen, because these have been down the line in headlines, we haven't seen this very much, but what's been happening underneath this all is something called stock buybacks. Big corporations are buying back billions and billions of dollars of their own stock. In effect, by doing that, they're taking their shares out of the marketplace. Now, why is that so important? Well, in effect, if a company earns $1 a share, John, and they just eliminated 3% of their outstanding stock in the marketplace, simple math tells me that that's going to increase their earnings per share by 3%. Since most corporate executives are compensated through stock grants, it makes a whole bunch of sense, if you're in the shoes of a corporate executive, to do whatever you can to increase earnings per share. So long story short, the majority of the demand being created today is really the result of corporations reducing stock supplies. So I just thought that was a bit of interesting curiosity to share with our Saturday Summary viewers today as to why these stock markets have actually grown to the levels they've grown to, up 160% since 2008, without the underlying economic support or the demand from investors to justify it. So that's all we've got from here at 401k Masters and Gebhardt Group. I hope everybody has a prosperous week ahead. Take care, John. We'll see you next time.